go ahead and jump in, I guess, so we make sure we have plenty of time for questions and everything else at the end. So hello to everybody that's here. Thank you so much for joining us today. For those that have been to the previous couple that ALN has done with Dr. Debbie from the Quadrillion, welcome back. And since for this one, I'm assuming more of our attendees are going to be on the ALN side, I thought we'd go ahead and start this one off with giving Dr. Debbie a little chance here to introduce herself and what she does.
Well, thank you so much. It's just great to be here. It's a Thankful Thursday, and I'm thankful you are joining us. I'm Dr. Debbie Phillips. For those of you who don't know me, I'm a 33-year industry veteran, and my role as the apartment doctor is to really support high-performing teams that enhance value. And, I just believe in the words of Walt Disney: you can build, dream, and create the most beautiful places in the world, but it takes people to make the dream a reality. And so I love today that I'm sharing this platform with ALN because, we're only as strong as our knowledge and just to share this information. But I want to just challenge all of you today to get a pen and a paper and write these notes down, because as Jordan goes through all this, I'm going to tie a bow around it at the end and really talk about how we can transfer this information into some results that are going to perform at a higher level. So with that, I'll turn it back over to you. It's a great day and welcome to the program.
All right, thank you for that. And let me go ahead and get my screen share going. And I'm going to assume that most people on are familiar with ALN, but just to give you kind of a high level description really quickly. ALN started in 1991 as an apartment locator in Texas. We kind of slowly expanded both geographically and in the sectors of the industry that we service from there. We've been fully nationwide since 2015, and we have at this point multiple web-based platforms for your specific use case and segment of the industry. So for apartment associations, for supplier partners, owner operators, really everyone in between, appraisers, et cetera. So the idea behind this presentation, and for those of you that were on our previous two, we've kind of taken a couple of different tacks. For this one, our concept here is a 2020 autopsy for multifamily. And the idea is really to look through what happened in 2020 at a fairly high level. We'll be focusing more on 2020 as opposed to in the previous webinars. We did a little bit more comparing to previous periods of time and things like that. So we're not going to get quite as granular on this one. It's going to be a high level view specifically of 2020 for the most part. And make sure to save your questions. We'll make sure to get to as many of those as we can at the end. And before we get into some information, some pertinent details about ALN's methodology that's going to have an impact on the numbers that we're looking at here. ALN does all of our research in-house, so we're not relying on third-party data providers for any of this information. We track conventional, affordable, student, senior, and military housing, but the main focus of our research is on conventional properties of at least 50 units. The main reason for that being that we're reaching out to these properties on a 5-week rolling basis, and we found that it's much easier and more efficient to get high quality regular updates from a property sort of above that size threshold. So keep that in mind as we go through. For the most part, the statistics are going to reflect that subset of properties. We do track all price classes, and we rely on collected data, not market sampling. So we're not going to contact 10% of properties in a market and then extrapolate that out. We contact all of these properties. And with that, let's jump in. So I did want to provide a little bit of context with some sort of economic and jobs information before we get to, let me see if I can get that out of the way. There we go. Before we get to the multifamily information. So what we're looking at here is what happened with the labor force in 2020. Basically, the top of this sort of gold shaded region is going to be the total civilian labor force. And the top of the blue shaded region represents the employed labor force. And so really the width of that gold band will be the unemployed labor force. And then the white line that you see, that's the unemployment rate. And sort of the y-axis there on the right-hand side corresponds to that unemployment rate. So, of course, we see really around the March and April timeframe a big reduction both in the labor force itself and a likewise large increase in the unemployment rate. The unemployment rate was on a pretty good, trajectory downward for really as we moved through the second quarter and into the third. You can see that tailed off really in the fourth quarter. And the labor force participation bounced back a little bit up around the May, June, July timeframe and really kind of stagnated after that. So we're still down about 4 million jobs or so in terms of people active in the labor force. So another sort of angle of this to look at is jobless claims. And on the left-hand side, we're looking at weekly initial claims. And on the right-hand side, we're looking at weekly continued claims. And I went ahead and used the 4-week moving average here just because there was a lot of noise in this weekly data, but particularly early on when the government was trying to figure out how to collect all this. So you can see obviously on the left-hand side with the initial claims, that huge jump up in the March and April timeframe. Pretty dramatic reduction as we went through April, May, and into June. And then as with what we saw on the previous slide, the progress did kind of tail off as we approached the fourth quarter. And you can see we're still hovering around 900,000 or so weekly initial claims, which is a huge number for sure. On the right-hand side, the continued claims, same thing. The reduction wasn't as immediate after the initial jump. You can see the downward trajectory was a little bit of a shallower slope, and it tailed off a little bit later than the initial claims. So the initial claims really started tailing off and kind of stabilizing in August or so. The continued claims really didn't stabilize until November, really. And you see those are hovering right around 5 million for the continued claims. So a lot of disruption, obviously, on the employment side. So with that kind of as the frame, we can now kind of get into some multifamily results. So what we're looking at here on the left-hand side is just basically your kind of supply and demand. So new units and net absorption, meaning the net change in the number of rented units for a period of time. And really you can see that demand was outpacing supply nationally in multifamily in both 2018 and 2019, though that had already started to winnow. We saw a pretty good demand reduction in 2019 that preceded the onset of COVID. And then in 2020, of course, the most noticeable thing there is the substantial decrease in apartment demand. What's interesting is that after the second quarter, about halfway through the year, we were down more than 40% nationally in apartment demand. And by the time the year ended, we were down only about 14%. So there was a pretty good resurgence in the third and fourth quarters. And that's what we're looking at on the right-hand side. So with 2020 broken down by quarter, you can see in the second quarter, really when COVID really set in and we went into various lockdown procedures across the country and things like that, both the level of new supply decreased and, of course, the demand decreased. And then Q3 really kind of saved the annual numbers. When you look at that demand result there, we had a big bounce back in the third quarter. And in fact, the third quarter demand actually did better than Q3 in 2019. So a lot of the overall annual numbers can be attributed to those last two quarters compared to how things were looking at mid-year, which was significantly more dire. So this graph, same idea as the labor force that we just looked at, but now we're looking at rent and occupancy for multifamily. So the top of the gold region is average rent, which would be the average asking rent or market rent. And then the top of the blue region is average effective rent. So that's the actual collected rent. And so the width of that gold band will essentially be your concessions. And then the white line is average occupancy. And once again, that corresponds to that y-axis on the right-hand side. And so I do want to point out, you'll notice, particularly for the occupancy axis, there's not a whole lot of change in those axis labels. I wanted to show you more the trend than anything else. So, this looks like a pretty dramatic change, but, really we're talking about starting the year around 92% and ending the year about 91.8. So there wasn't actually much net movement during the year, but I did want to show you kind of what happened on a monthly basis, which is you see kind of a downward trajectory entering COVID, which is typical because we expect to see a little bit of a softening in the first and fourth quarters. And the big difference this year, of course, was that normally the second and third quarters are really strong for multifamily, and the second quarter obviously was far from strong, given that's when COVID really hit. So the other thing to point out here is you'll notice that average effective rent, the blue shaded area, has actually declined. Did decline through the fourth quarter of 2020, whereas the asking rents really started increasing again in the June-July time frame. So operators were trying to be a little bit more aggressive with asking rents really as we came out of the second quarter, and all that really did was increase concessions because that was not able to be converted into collected rent. And on the topic of concessions, here we're looking at, on the left-hand side, the availability of lease concessions, and on the right-hand side, the average value of the discount offered. So this was a trend, particularly the availability of concessions. It was a trend that preceded COVID. All through 2019, concessions were pretty much on the rise at the national level. That, of course, continued in 2020, but at a higher pace, and you can see that pretty steep linear slope up through most of the year, really starting in March. And on the average concession value side, we measured that in weeks off of an annual lease. So coming into 2020, the average discount value was about 3 weeks off a 12-month lease. And you can see that as we closed 2020, that was up over a month off. So there was a pretty significant increase both in the availability of these discounts and the average value of discounts. And that, of course, corresponds with what we saw on that previous slide with that really wide concession band. So kind of putting this all together, net rent per unit gives us the perspective both of occupancy and rent. And again, it's not that there was a massive change here, a net change throughout the year. But again, I did want to show you kind of what happened with the slope of that line throughout the year. And all told, we ended about $5 or so lower at the end of the year than we started in terms of net rent per unit. And you can really see that once again, that started in the March-April timeframe. We got a little bit of a bounce in the third quarter, and then it tailed off as we approached the end of the year. And something else that's important to keep in mind, typically we think of occupancy as a pretty safe assumption that most occupied units are going to be generating full rent consistently, which is something that changed this year. There's something I like to point out when we do these presentations. I know we've all probably been following the NMHC rent tracker throughout all of last year. That's measuring full or partial rent payments. And so it's really hard to nail down what share of those were partial rent. And so for 2020 results in particular, we really can't assume that we can take the occupied units multiplied by the average rent and come up with a perfectly accurate figure there in terms of cash flow. So just something to keep in mind. And so with this presentation in general, we wanted to be a little bit more positive where appropriate than maybe we were in the first two, given everything that happened. And so two things that I really wanted to point out. The first is a view by price class. National numbers are pretty heavily skewed, of course, by the largest markets, and we'll look at that next after price class. But it's also important to look below even just market level numbers or the national numbers at price class. So ALN, as our clients will know, we categorize every conventional property of at least 50 units to one of four price classes, A through D, based on its percentile rank for average effective rent in its market. And so what that does is it allows us to compare more apples to apples, where we can look at a Class A in Los Angeles and a Class A in Des Moines, and they may not be comparable properties along all metrics, but they operate in the same space within their respective markets. And so what's obvious here, first of all, on the left-hand side with average occupancy, you'll notice that Class A, of course, lagged behind B, C, and D. And that's typical, obviously, because Class A properties are the properties most directly dealing with competition from the new construction pipeline. So we would expect the average occupancy there to lag a bit. But you'll also notice that the annual percent change, which is represented by those gold dots, was more significantly negative than classes B, C, and D. And in fact, classes C and D managed to maintain occupancies through the year. The other thing that's positive to point out there is for classes B, C, and D, despite everything that happened last year, occupancies remain above 90%. On the right-hand side, we're looking at the same thing, but for average effective rent, and kind of a similar story. Class B lagged behind C and D, with Class A being the most heavily impacted. And that kind of fits in with what we've seen from a variety of perspectives in terms of kind of a flight to affordability last year. Class A, generally speaking, was hardest hit in just about every market. You can see that Class C and D did manage to add a little bit to average rent. Class B retracted, but by less than 1%. And so again, the good news portion of this is that some of these negative results were pretty concentrated in the Class A subset. And we saw, fairly positive or at least neutral results elsewhere. And same thing here, except we're looking at concessions again. Concessions were another big story from 2020. And so you can see that really Class B, in terms of availability of lease concessions, was where we saw the largest gain through 2020, just narrowly beating out the gain that we saw in Class A. Of course, the difference for Class A being that significantly more properties were already offering a concession, plus they had basically that same level of growth. So all told, ending the year, Class A was about a little less than 30% of properties offering a discount. Class B finished at just under a quarter, and you can see classes C and D are both under 20%. In terms of average concession value, kind of an eye-popping number there for Class A, more than 5 weeks off a 12-month lease. So we're pretty significantly above a month off at that point. Same thing for Class B, really, though. I mean, more than 4.5 weeks off. Just a hair under 5 weeks off an annual lease, and then pretty significantly lower the C and D properties down there are still below a month off. So the other perspective that I really wanted to show, in addition to price class, is market tier. And ALN assigns each of our more than 180 markets around the country to a market tier 1 through 4 based on the size of the multifamily presence in that market. So we don't base it off of population, we base it off basically multifamily stock. And again, that's with the idea of getting better comparisons from a multifamily perspective, not necessarily just by population where they may have a significantly higher or lower rate of apartments to single family. So the good news here is that, as with the price class view, you can really see that tier 1, which would be the largest markets in the country, the largest 33 markets, in fact, by multifamily presence, were really the markets that struggled. And particularly here on the left-hand side, when we're looking at average occupancy, you can see that those largest markets were really the only markets to lose average occupancy. And as you sort of progress to the smaller and smaller markets there, tiers 2, 3, and 4, occupancy did slightly better. And the smallest markets actually saw a pretty decent jump given everything else that happened last year. On the rent side, it's even more pronounced, the differences between market sizes. So those largest markets, and you can see how much more the rents are in those areas. Negative rent growth for those large markets. For tiers 2, 3, and 4, you can see pretty healthy rent growth. Again, especially all things considered last year, over 3% for each of those tiers. And so, as I said a moment ago, when we're looking at national numbers, those numbers are heavily skewed by these largest markets, as they should be. But it's something that's important to keep in mind, because obviously there's a lot of country between the two coasts. There's a lot of country other than these biggest urban markets. And for a lot of people operating in our industry in those areas, the 2020 looked very different than it did in the markets that tend to get more attention, those really big ones of Boston or in LA, et cetera. So wanted to be able to pepper in a little bit of reasonable good news there. And same thing here for lease concessions. So the largest markets have substantially more concessions available than in the smaller markets. Close to a quarter of properties in these largest markets. And you also see a much stronger rate of growth in the availability of those discounts through 2020, about a 40% growth in availability. Whereas you can see actually in tiers 3 and 4, the availability of concessions actually decreased in 2020. And on the average concession value side, there on the right-hand side, once again, pretty elevated values for tier 1 markets, more than a month off. And again, this will include all price classes. So for these largest markets, the average concession is more than a month, regardless of product type. And then you can see tiers 2, 3, and 4, basically as we get into the smaller and smaller markets, not only are the values lower for the discount, but also the rate of growth in 2020 is lower. So, all of this is kind of an indication that the demand situation was quite different in these markets outside of just the largest areas. And then lastly, I wanted to kind of show a view by floor plan type. So we track, efficiency units, 1 bedrooms, 2s, 3s, etc. We also track units with dens. And this actually is a perfect example of where you kind of have a hunch and then you wait for the data to come in and you see if it agrees with your hunch or not. So I kind of thought early on in 2020, we might see a little bit of a bump from a rent perspective in these units with a den, given that people are home more, maybe they're working from home, maybe they're doing their kids' school from home, etc. We didn't really see that in the rent numbers. You can see that the 1 bedroom versus the 1 den, there was a slight underperformance when you look at the 1 bedrooms versus the 1 with den. But other than that, the 2 bedrooms versus 2 den and the 3 bedrooms versus 3 den, really the den units underperformed. And we're looking at this on an average effective rent per square foot basis. But I went ahead and looked this up by rent per unit as well. And this does make a little bit of sense because the average rent, for example, of a 2 bedroom with a den is higher than the average rent of a 3 bedroom. And the average rent of a 1 den is higher than the average of a 2 bedroom. So it's certainly possible that people did want more space, but it was more economical to just get the extra bedroom as opposed to a den. Also, we should point out that, with a lot of annual leases, it's still going to take some time into 2021 for, a real high churn rate where we see maybe some of these differences in resident preference as their lease expires and they decide to move units or move properties, et cetera. And also there's the last sort of caveat here with the dens in particular. Only 3% of units across the country are units with a den. And so also you've got to be a little bit careful with a sample size that small. That can also kind of affect the number overall. So some things to keep in mind there. On the right-hand side, we're looking at lease concessions. So again, on the left-hand y-axis is going to be the percentage of properties offering the concession. And then on the right-hand axis is going to be your annual percent change for 2020. The efficiency units, you can see, are the highest in terms of annual growth, but it was actually the 1 den and the 2 den units that had the highest rate of availability in general. So again, sometimes you have a hunch and it doesn't pan out. All right, and then I did want to, I said we're not going to get too granular on this one. It's mostly a high-level view, but I did want to at least do a couple of things at the market level. So here we're looking at top 10 markets on the left-hand side for net rent per unit change. Myrtle Beach kind of stood apart from everybody else in the country, and then you've got kind of a group there that are very close together. Augusta has been a market that's really been doing well going back the last few years. Boise, in particular, has been a high growth market with a lot of California people going out to Boise and their little the tech boom they've got going on there. And San Bernardino Riverside actually was really the one California market that really stood out that had a pretty good year. Demand there was much higher in 2020 than in 2019. So that's good to see because a lot of the California markets, particularly the big ones, really struggled last year. And then on the right-hand side, we're looking at the bottom 10 markets, and you can see that the axis scale there on the left-hand side got a little bit messed up by Midland, Odessa, and Texas. And unfortunately for them, it was kind of a perfect storm of the latest energy crash combined with the fact that they were pretty overdue for some new supply, and they added some new supply over the last 2 years or so, right as COVID hit and right as the energy market crashed again. So you can see a negative 40% change for net rent in 2020, which is pretty astounding. For the most part, though, you can see we're really looking at some of the larger, expensive markets: San Francisco, Oakland, Boston, New York, DC, et cetera. And then you'll notice too, we've got Orlando, a travel market, tourism market. Same thing with Miami, and then Austin, again, kind of like Denver or Boise, one of these high growth markets from the last handful of years. Tons of new supply, really, really strong rent growth. And it didn't catch up to Boise last year, but Austin was one of those where, given those factors coming into the COVID pandemic, Austin struggled a little bit. Okay, so also one of the main factors, as always, but especially last year when we had such reduced demand, for how a market weathered the storm in 2020 was their new construction situation. And so as we look forward through 2021 and into 2022, one of the really important things to look at is going to be the upcoming construction pipeline for these areas. And what we're looking at here, the blue bar represents the number of units in the construction pipeline that have already broken ground. So I took out all the projects that are in a planning phase or permitting phase. Those are projects that generally could be put on hold or delayed based on market conditions. So here we're only looking at units that are going to come into the market really hell or high water, so to speak. And then the gold bar represents the net absorption in units for the last 2 years. And I did want to go ahead and include 2020 in that 2-year period because it's likely that we're going to have a little bit better results in 2021, given the vaccine rollout and economic reopenings and things like that. But we're not necessarily going to jump right back to pre-COVID levels of demand. So this gives us kind of a pre-COVID 12 months and a post-COVID 12 months in that 2-year span. And so I really want to point out, if we go to the bottom of this chart, you can see New York City and Dallas-Fort Worth really provide great examples of the two poles. So you've got New York City that has just a ton of units on the way that have already broken ground, but net absorption really not up to par with taking those units on as they're going to be entering the market in the next 18, 24, 30 months. Whereas a market like Dallas-Fort Worth, also very, very active, but the net absorption has been much stronger. And so again, as we look forward to what we expect to happen in some of these markets, a really big contributing factor is going to be how much of a headwind are the new units going to be. And also just to point out you can see Los Angeles, Orange County there, and San Francisco, Oakland, also a lot of units compared to fairly tepid demand in recent years. Okay, so this one's the exact same thing, but instead of just pipeline units, which is obviously going to be skewed toward the large markets, we're looking at pipeline units as a percent of existing stock. And I know the ordering of these look strange, but the reason that is because the blue bar still represents pipeline units as a raw number, but the ranking, so Honolulu being first, means that Honolulu has the most pipeline units as a percentage of their existing stock. So the order of these corresponds to sort of that percentage rank, but the bars themselves are still reflecting the raw numbers of new units and absorbed units. And so even adjusting for size doing this, you can see New York kind of stands apart there from everybody else. But, a market like Honolulu, for example, what for them is a pretty large amount of new supply compared to the fact that their last 24 months of absorption has been, almost a net zero units. A market like Orlando, you see there, Asheville, North Carolina, some of these markets that came into COVID as really strong growth markets, we're still seeing that reflected in their new construction activity. And so it's really going to be important to see to what extent and how quickly their apartment demand returns to sort of a pre-COVID level, or at least in that neighborhood. All right, so also one of the things that we wanted to talk about is just a perspective, what's expected in terms of sales volume, sales prices, investment activity in multifamily in general, cap rates. And because that's not something that ALN really tracks internally, I went ahead and reached out to a contact that we worked with before, Will Coleman, Director of Finance at Rand Capital, great capital company. And I just asked him, I said, give me a little bit of your thoughts on what you expect to see in terms of investment activity, and particularly in these secondary and tertiary markets that weathered the storm better in 2020. And his point really, and I'll let you read that, but for the most part, his point was that these secondary and tertiary markets that have strong population growth trends, we're going to expect to see lower, prices increasing, cap rates compressing, if those areas don't have the new construction to really make up for that increasing population and the increasing demand. Whereas in these secondary and tertiary markets where the population trend is declining or there's kind of tepid growth, he's kind of looking for cap rates to stagnate or rise. So with that in mind, I thought what I would show you all, we got 2 slides here. So these are secondary and tertiary markets, which for ALN would be our tier 2, 3, and 4 markets. And on the left-hand side, we're looking at the top 10 markets for population change over the last 4 years. And comparing that to the pipeline units that are coming into the market that have already at least started construction. So again, these are units that really, no matter what, are going to be entering the market. And so on the left-hand side, you can see a market like Boise there at the top, really strong population growth, not a ton of new supply on the near-term horizon. And so that would kind of fit Will's first category here of growing population, but low new supply. On the right-hand side, we're looking at bottom 10 markets for population change. So these are markets that have lost the most population over the last 4 years, going 2016 through 2019, and also looking at what their new supply situation is. So obviously a market like Shreveport, you don't want to see that level of population loss, but maybe a silver lining is they also don't have new construction on the near-term horizon. Whereas a market like the Buffalo area in New York, they've suffered some population losses, and they've got some new supply that's expected to hit the market in the next year to year and a half to 2 years. So with that dynamic in mind, that's going to be another piece to the puzzle, particularly as people look not just in these largest urban markets, but where should we expand in the secondary markets and the tertiary markets. Obviously, tracking the population change there is going to be a big piece to that puzzle. And then same thing, I like to do all this stuff by raw number and then by percentage as well to kind of adjust for size. Because even, we're talking about secondary and tertiary markets, but there will be some difference between a larger secondary market and maybe a smaller tertiary. So here again, on the left-hand side, top 10 markets for population change. On the right-hand side, bottom 10 for population change. And then again, their level of new supply. And what you'll notice on the left-hand side in particular is a lot of these areas with strong population growth relative to their size don't actually have a ton of new supply on the way. And so that's going to be something where we would expect to see increasing rents and things like that. On the left-hand side, we've got some pretty strong population losses and more of a mix. Some of these markets don't have much near-term new supply on the way. Others do, like a Birmingham or Grand Rapids area, something like that. So again, something to really pay attention to, population mixed with near-term deliveries. And with that, let's turn it back to Dr. Debbie. I know I kind of went through that as a little bit of a drinking from the fire hose type of deal, but let's circle back.
Well, I want to call our attention to Kelsey had a question, and she said, when you were talking about concessions, are those concessions actually dollars off the rent, or were they gift cards? Did you have any information on that?
So we don't track the sort of the form of the concession. For us, it's just what is your asking rent and what is your collected rent, and then that difference is the concession. So unfortunately, we don't really get any more granular than that in terms of what's the form of the discount. Okay, and Paul Garcia, take yourself off mute and ask your question about the pricing of those 1 bedrooms. I think he had a question about the average rent of 1 bedrooms. Paul Garcia. with us, Paul?
I'm not sure that Paul may still be on, and we can definitely circle back with him. But to kind of take as Jordan said, an autopsy, or let's talk about the triage. And I want all of you, remember your early days in property management when you learned about people, price, product, and promotion. Let's talk about this. And in my real estate classes, I want to remind everybody that the three factors that really dictate demand are three important things: population growth, household formation, and employment growth. And Jordan, I know we've seen that leisure and hospitality jobs have taken a huge hit. As well as, business and professional services. And I was particularly interested in this data around the concept of den. I think we talked about that on our last call. If you think about people, price, product, and promotion, I want to encourage every one of you on the presentation today to take this data and sit down with your regional directors and your property managers and look at this and say, okay, how does this national data really compare to what's happening on your portfolio and your sites? So if you're taking notes, I want you to write the term knowledge transfer, because as the apartment doctor, I'm always encouraging you to think about who can take your place. And you say, oh, Debbie, I'm not ready to leave yet. But the more we know, the better we can do. And I think that this is important. I also want you to think about inspecting what you expect. When it comes to pricing, if you don't ask, you'll never get yes. So there's opportunities, as Jordan described, for some rent growth. And I think we need to pay attention to how we're presenting these apartments. I listen to a lot of mystery shops, and Laura, will agree with this, I'm sure. But do you have people that are just giving a commercial about these apartments, or do we have professional salespeople that are really presenting these floor plans and talking about the unique value proposition with each floor plan? When I look at these one bedrooms with den, how are we selling those? And I know that we're doing a lot of virtual leasing right now. But at the end of the day, if we haven't really dissected every one of our unit styles and haven't created a special presentation around each type of floor plan, we're really missing that opportunity. So in terms of people, let's get the mystery shops done. Let's listen to these phone calls with the prospects. The other thing in terms of pricing, we got to be able to sell price. When I look here on this particular slide and I look at, the 3 bedrooms, and you think about your highest average effective rent right there on those 3 bedrooms, as opposed to the 3 bedroom with den, that third bedroom, is it being used as a home classroom? Is it being used as a home office? Is it sharing the rent with somebody that might have lost their job? So, Fake Popcorn talked about cocooning. Do you have a third roommate? So it's really, really important to drill down to say, who is the actual consumer of that particular apartment? The other thing that I wanted to say is, on promotion, sell the sizzle. Okay. A lot of your older communities, and Jordan talked about this, a lot of your B and C asset classes are performing better because some of those are older properties. You've got more green space. And I just want you to pay attention and look for opportunities. I get fired up about this, okay? Because the reason I get fired up about it is your leasing team you need to have a huddle on, and I know all of you have COVID huddles to talk about opening and closing procedures. But what I want to encourage you is to have a huddle to talk about nothing but your unique value proposition. Okay. And if you're class A, you got a lot of walkability, you got a lot of connectivity into a lot of those markets. But on the B and C and D class, guess what? You got a lot of space. You got a lot more floor plan to work with. So I want you to encourage your sales force to get radically fired up about what they're selling. So let's just review real quick because we're almost done. People, got to get them mystery shopped. You got to have aggressive, ready salespeople. I know a lot of us are working with skeleton crews and the A team and the B team, but let me tell you, everybody's got to be prime time. Okay. I was at an office the other day and I heard the phone ringing. And guess what? I'm like, let's answer the phone. We can't be just leasing apartments through the World Wide Web. People are still calling, and we got to have that sense of urgency. Not everybody needs to know that you got 15 or 18 one bedrooms. You got to sell like you only have one. Okay. So get your people fired up, really pump up your sales team. On price, know your best in class. Know the floor plan that you can't keep it on the shelf. You know what I'm talking about. So you raise the rents in those unit plans, and then you adjust the prices. Jordan knows I don't like the word concessions. I love the word incentives. I'm going to give you an incentive to come on into this community. But if you have to concess something, that means, hey, you might not be performing at your best. So change the language. Let's sell on incentives. Okay. So that's the price. The product still got to be clean. We're driving by these properties at night. I don't know about you, but everybody's got Zoom fatigue. I can't wait to get out from behind my screen every day. So I'm riding properties. Well, guess what? You got to have great lights on your signage. You got to make it look like a resort. Is it worth driving through or calling the next morning? So does it have that curb appeal, or has it lost its luster? See, I get fired up about some good curb appeal. You got to have a happy property. You know when it looks like it's dead. Well, you got to liven it up. You got to pump some juice into it. And then the last thing I want to talk about is promotion. Today I see so many properties, building their brand through social media. And I wish sometimes we really were as good as we looked. I just want to make sure that our enthusiasm and our passion matches up to what we're putting out there on that social media, because today it's about building community. And and Jordan and I and Laura talked about it on our 2020 calls. People want to live where they feel that it's vibrant. Okay. They want to live where it's clean. They want to live where they can live their best life. So on the promotion, I know we're pumping a lot of money into our social media, but let me tell you, the power that your salespeople and your whole team, y'all know what it is when the team is lacking the vibrancy and the enthusiasm. So, I talk about people, price, product, and promotion, but there's nothing that sells like passion. So that's what Dr. Debbie has for you today. And it's just been a joy to share this with you. Always, we need each other. And Jordan, thank you again for being I won't call it the mad scientist, I'll call it the data scientist,
There we go.
because your brain works in incredible ways and you've given us such great information. So anybody
Well,
else want to have any questions? I'll read the chat.
yeah, so I was going to say, I was going to add one detail to what you said, and then let's get some questions in here for the last a few minutes or so. I saw some hands going up as we were going through that. So the one quick thing that I wanted to add, Debbie talked about sort of the fundamental building blocks of demand being population growth, job growth, and household growth. If I can just do a little shameless plug here, for those of you that are already ALN clients, we released a new report recently called the Msa Report. That's already available on the home screen of your login when you go into any specific market that you have access to. And that report shows population growth, household growth, and job growth for every MSA in the country, for every market that we cover. And so that's been part of our push, is trying to help you fill in the gaps, not just the multifamily data that we're providing to you, but also fill in the gaps with these other factors that you need to know. And you don't have to go, dig it yourself or go talk to an analyst. It's right there in front of you, graphs, tables, et cetera. So be sure to be on the lookout for that next time you're in the programs.
Ron Flippin wants to know if you happen to track any trends with pet charges, fees, and deposits.
We do track, I believe, and I don't want to lie to you, I'm 99% sure we track pet deposits as an amenity or as a feature of the properties. I'm not sure that we track the change in what that fee is. So for that question, shoot me an email, jordan@alndata.com, and I'll be happy to do some digging for you.
And I know Pat Patterson was on the call. She may have some of that data too. So anybody else got any questions? Hope this was helpful. And if you just have a minute, just put in the chat what you would like to talk about. Michael wants to know, do you track any internet speed availability at the property?
We do track high-speed internet at the property level, whether they have it or not. I don't believe we're doing fiber yet, though I might be wrong in that. That may be a new addition. I know for sure that we do track high-speed internet. And
Mary Day, she wanted to know if we were going to make this presentation available. Absolutely. Yes. And Kathy Stevens writes, there is new construction summary. And prior, in addition to this, as there was an Excel spreadsheet that showed the actual property names. Is that still available?
In our programs, when you click on the new construction report, that's exportable into Excel. So yes, that's still available as a function of all of our platforms.
Excellent. And I know Kathy could relate a lot about what I was saying about ready and aggressive salespeople. So I appreciate you being with us today, Kathy. Anybody else? Oh, there's Pat Patterson, and she's at Pet Screening, and she does have pet data. So Ron Flippin, email Jordan or me, and we'll connect you to Pat for sure.
Awesome.
Anybody else? Let's just double check before you leave the doctor's office. All right. Brian said, Jordan, specific to employment growth, how much weight should we put into employment growth forecast? And what are you seeing as far as forecast?
Yeah, that's a good question. The thing about forecasts is we base these models on what typically happens, generalizations and simplifications of the real world. And so, in a time like 2020 and the COVID disruption, obviously that makes things more challenging. And then obviously we don't know to what extent we're going to see work locations changing, as we've seen particularly in the Bay Area, large social media companies saying they're full remote indefinitely, and so there's going to be some changes there. Honestly, I've seen some projections kind of all over the place, and I hate to give you like a a definitive answer here, because the truthful answer is there's a lot unknown still. Particularly when you look state by state and different levels of economic reopening, some states going back into lockdowns, some never locking down. There's just a lot of noise in the data right now. I do think it's reasonable to say that short of some further unforeseen calamity, which let's all find some wood real quick. But 2020 should realistically probably form some sort of baseline moving forward into 2021. We assuming that the vaccine rollout continues, assuming that it has some level of effectiveness, assuming that economic reopening can continue as we move through 2021. We shouldn't see any further slide than what we saw in 2020. And we also don't know, it's hard to pinpoint just what the level of pent-up demand is in 2020, particularly when you talk about markets that are heavily skewed toward, hospitality, tourism, retail. As we sort of reopen and travel starts again, we could see, given the unemployment situation, people sit on their disposable income. We could see everyone that's been pent up in the house for a year plus just immediately start traveling. And so there's still kind of a lot of play in the joints that we're going to have to see, particularly over the next couple of months as the vaccine rollout continues. That's going to have a big impact on sort of, are we going to be at the high range of a positive projection, or where are we going to be on that threshold?
The other thing, Brian, I would say too, is pay attention closely to your resident profiles on your sites. And when you're looking at trends and you're really dividing up, the major employers on your particular properties, then go deeper to some of those thought leaders at your communities and say, hey, what is your company projecting? And so really drill down to the resident profiles and do some surveys on your property. Jenny raised her hand. Jenny. Let's see what Jenny has. Jenny, you can unmute. We're a family. Let me see if I can go to Jenny and maybe I have her.
See if maybe we have to do it.
Maybe I have to unmute Jenny. Oh, here we go. There's Jenny.
All right.
Jenny, ask your question. Or type it in the chat. Haven't heard from Jenny.
Yeah, it's not liking our attempt to unmute here.
Sorry about that. I did that by mistake. Sorry.
Oh, that's okay. Welcome to the program. Did you have a comment or other question you want to share?
No. Thank you. And appreciate the information.
Absolutely. What sector are you in, Jenny?
In Central Texas.
Okay. And how many units do you have under management?
Right now I don't have any, just passive investment in 1,300 units, but we're looking, and I'm attending the webinars from you and from Real Page.
Yeah. Excellent. Well, welcome to today.
Thank you. And sorry about the raise hand. It was
no problem. We're just glad you're here. Anybody else? All right.
Well,
Gordon, thank you for this great opportunity, and just stay tuned. Follow our social media channels for future programs, and just remember, you don't get what you want, you get what you focus on. So focus on success, be well, and let us know how we can help. Thank you for attending today.
Thanks, everybody. Have a great week.
All right. Bye, Jordan. Bye, Laura.